Good morning. You're watching All You Need to Know on BloombergQuint Live, and I'm Alex Matthew. First, the headlines. India has decided to exit the Regional Comprehensive Economic Partnership, or the RCEP, as significant issues of core interest remain unresolved. The Supreme Court of India orders a ban on all construction activity in Delhi and has instructed the Punjab and Haryana administration to ensure prevention of additional stubble burning. Bajaj Finance has launched a qualified institutional placement, or QIP, issue with a floor price of 4,020 rupees per share. This is a 2.3% discount to Monday's closing price. BloombergQuint was the first to report this on a Friday afternoon. Tech Mahindra and Titan Company are the two Nifty 50 constituents set to report their earnings later today. And Burger King India has filed for an initial public offer with the Securities and Exchange Board of India. The company looks to raise 400 crore rupees via a fresh issue of shares. Let's talk about the US markets now. They continued where they left off on Friday. The Dow Jones hit its first record closing high since mid-July, joining its peers, the S&P 500 and the Nasdaq, to sit in a record territory. Near-term trade optimism coupled with better-than-expected earnings on Wall Street is adding to the risk-on sentiment. Renita Young of Bloomberg News is here to tell you all about that in this report.
U.S. markets closed at record highs on Monday. All this trade optimism fueled demand for risk assets. And this happened after U.S. Commerce Secretary Wilbur Ross said that the White House would not have to impose tariffs on imported vehicles at the end of this month after all. No surprise that after that we saw vehicle stocks and energy stocks rise on the day. And we also saw WTI crude oil as well as the Bloomberg Dollar Spot Index rise. But what did not rise were safe haven assets. And rightfully so, since investors were not seeking to store the value of their assets. We saw gold and treasuries take a little bit of a plunge during the day. And also during the day, we saw a lot of companies news, McDonald's dominating many headlines during the day after firing its CEO for having a consensual relationship with an employee. However, that relationship was against company policy. Later in the day, we saw McDonald's chief people officer resign. It's no sign as to whether or not those two situations are related. We also saw Under Armour plunging on an accounting probe and lowering its full year forecast. But next up in earnings, we'll see Groupon and Outfront Media. And that's a look at your Wall Street action on Monday. In New York, I'm Renita Young for Bloomberg News.
All right, now the Ministry of External Affairs of India has announced its decision to pull out of the RCEP trade agreement. The ministry has cited national interest as the reason behind the decision. According to sources in the government, the Indian domestic industry is still reeling under the impact of unequal deals and past issues need to be resolved before signing any new deal. Here's a report by Tom McKenzie of Bloomberg News.
China has really stepped on the gas on this issue. Rcep, the Regional Comprehensive and Economic Partnership, involving now 15 countries, because precisely as you say, they are facing, of course, these pressures from the US on the trading front, so that they've wanted to step up this deal to try to build out an economic partnership with countries, of course, including the likes of Japan and Australia. Not India, though, as you say. Now, they've stepped away from this. They're not going to be taking part in the deal at this point because they're concerned that they're not going to get access to some of these markets for their professional services sector, and they're also concerned about a flood potentially of cheap Chinese goods into their markets, which could really put pressure on some of the core constituents who really support Modi and his government. So they've decided to pull out of it. It means the 15 countries are likely to sign this deal, we're hearing, in 2020. And of course, China, which has been much of an architect of Rcep, has said that India is still welcome to join at a later stage. But again, it is an example of China building out its economic and trading ties in this region, even if the likes of Wilbur Ross dismissed this trade pact as something of a low-grade deal. It does, though, have significance for China and its trading partners in the region.
All right, let's also listen in to what the Ministry of External Affairs had to say about the issue.
Prime Minister's last engagement was his participation in the third Rcep summit. India conveyed its decision at this summit not to join the Rcep agreement. This reflects both our assessment of the current global situation as well as of the fairness and balance of the agreement. India had significant issues of core interest that remained unresolved. In his remarks on this subject, Prime Minister highlighted that he was guided by the impact it would have on the lives and livelihoods of all Indians, especially vulnerable sections of society. He spoke of Mahatma Gandhiji's advice on recalling the face of the weakest and the poorest, and then ask if the steps are of any use to them. India has participated in good faith in the Rcep discussions and has negotiated hard with a clear-eyed view of our interests. In the given circumstances, we believe that not joining the agreement is the right decision for India. We would continue to persevere in strengthening our trade, investment, and people-to-people relations with this region. The reasons for not joining are the participating countries are aware of it. And I can say that we have had a very clear and a principled position for a fair and balanced outcome of the Rcep. But when we did not see that, and we found that, and you're very clear, it is in my remarks why we have taken the decision. We took the right decision in national interest.
Vijay Thakur Singh there of the Ministry of External Affairs speaking at the Rcep summit in Bangkok. Let's take a look at the Asian markets now. Rosalind Chin is joining us live from the Hong Kong studios. Good morning, Rosalind. How are we looking in Asia today?
Well, talking about a different kind of trade deal, we've got the US and China, of course, with a little bit of movement there. The Financial Times has been reporting earlier today that the US has been debating whether to roll back levies on about $112 billion of Chinese imports, and also hearing that China is looking at locations where they could possibly sign a Phase 1 trade deal with the US. This, of course, a trade deal between China and the US, one of the big things that investors are looking ahead to, and one of the things which, of course, the US, because the US is not part of Rcep, a big deal as well. So we've got much of Asia actually looking mixed after the Chinese markets opened. It had been trading a little bit more positively earlier in the session. The MSCI Asia Pacific Index now trading up by about 1/3 of 1%. Japanese markets playing catch up after a public holiday yesterday. Those are leading the gains in the region. The Nikkei 225 up by 1.3%, and Topix Index up by more than 1% at this point in time. We've got Hang Seng Index losing 1/4 of 1%, and Shanghai and the CSI 300 pretty much flat right now, but actually dipping into negative territory. It's the start of the Shanghai Import-Export Expo today. This is the second big expo that the nation has had, and Xi Jinping is expected to be making a keynote speech shortly. In fact, I believe he's delivering that speech right now. French President Macron is also at this event, and Xi Jinping is expected to be talking about China's commitment to further opening up the nation and the economy, and also this is really his first opportunity to address global investors since the US and China started trade talks once again in September. So we should be interested to find out what else he's going to be saying in the next hour or so when he's speaking. We're also looking at Australia. The S&P ASX 200, that is just about flat, but peaking into positive territory right now. Of course, we're waiting for the RBA because that's going to have its rate decision out. We're expecting, of course, most economists saying that they're going to hold pat this time. Philip Lowe, the governor of the RBA, will be giving a speech later today. Of course, we're expecting that after 3 cuts in June, there won't be a lot of changes there, but there have been some concerns about perhaps rate cuts going too far in Australia. Back to you.
Thanks so much for that, Rosalind. All right, let's also take a look at what else is making headlines across the globe. Ritika Gupta of Bloomberg News brings you the first word headlines.
President Trump has formally begun the process of withdrawing the U.S. from the Paris Climate Accord. It's a move that will take another year to complete. The administration has submitted formal notification of its withdrawal to the United Nations, but will continue to work on the issue with, quote, a realistic and pragmatic model backed by real-world results. About 200 other nations remain in the agreement. Southeast Asian leaders snubbed a meeting with the U.S. at the ASEAN summit after President Trump skipped the event for a second year. Thailand, Laos and Vietnam were the only countries to meet National Security Advisor Robert O'Brien in Bangkok, the smallest delegation since President Obama upgraded ASEAN ties in 2011. Washington is said to have complained about, quote, an intentional effort to embarrass President Trump. Iran has increased the number of advanced uranium centrifuges it's operating in a further violation of its fragile 2015 nuclear deal with other world powers. It's added 30 upgraded machines that can enrich fuel 10 times faster than existing models. President Rouhani is expected to announce further moves later this week. The news comes as the Islamic Republic marks the 40th anniversary of the U.S. Embassy siege in Tehran. And anti-government protests are continuing in the Chilean capital Santiago, with police using water cannon and tear gas to disperse large crowds. At least 20 people have died in the protests, which started last month after the government announced a hike in subway fares. The movement quickly expanded to protest frustration over education, health services and growing economic inequality. Global news, 24 hours a day on air and at TikTok on Twitter, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rcep Gupta. This is Bloomberg.
All right, let's turn to the Indian markets now. Agam Vakil is here to tell you all about the day's trade and also what's happening in the futures and options space. Agam, we've been gaining for a few days now. Any chances of consolidation today?
That's the exact question everyone's going to be asking, Alex. 7 straight days of gains. Can we see some amount of consolidation? Well, a lot of analysts out there are suggesting that consolidation may very well be on cards because, well, the indices honestly have run very quickly. And they have, returned to levels that no one was really expecting them to come back to. That said, for now, the strength is, it seems, here to stay because the SGX Nifty isn't really indicating a very sharp down move, well, a decline all the same indication. But what did we see yesterday? As far as the Nifty is concerned, another 0.4% gain coming in. But the small cap and the mid cap indices really didn't follow through, underperforming. What about the banking indices? Well, again, flat for the Nifty Bank. The PSU banking index did advance, however, by around 0.7%. Now, we did see the likes of ICICI Bank, HDFC, well, give us mixed moves. And in terms of other ADRs, we are looking at gains in Infosys. That's up 2.5%. Of course, is following a clarification from the company on, clarification sought from the exchanges on the whistleblower complaints. Let's move on and talk about other factors here. And fund flows, FIs have turned net sellers now. This is to the tune of 139 odd crores. DIs also sold in yesterday's markets to the tune of 500 crores. Moving on, let's also talk about, well, your contributors. We have HDFC, Infosys and ICICI Bank advancing, and to a certain extent, partially being cancelled out by Maruti Suzuki, HUL and HDFC Bank, along with IndusInd Bank. But what about futures and options? What are we watching there? We've seen about 3% increase in open interest towards fresh longs for the Nifty. The banking futures are seeing a 15% addition, but not necessarily towards longs, even though it did close marginally in the green. And moving on in terms of options, we're watching out for the 12,000 mark, of course. That's where the most amount of activity is. But we also saw a little more writing around the 11,600 put. Based on that, the maximum open interest remains with the 11,600 put and, well, 12,000 on the higher end. And, as one might suspect, a little more writing around the 11,800 and 900 puts. So we did see the WIX advance by around 1.5%, still below the mark of 16, relatively comfortable. The Nifty put call ratio edging slightly higher at around 1.43. And as far as your stocks are concerned, we have Kerala Health, Apollo Tyres, Cholamandalam Finance in focus with a surge in open interest. Z Entertainment saw a lot of shorts building in, And in terms of stocks which are seeing unwinding, well, Dish TV took a little bit of a knock of 10%. Amara Raja Batteries along with Sun TV among others, which are also seeing longs unwind. So Alex, it was a mixed day of trade and something that we can expect in today's day of trade as well.
Thanks so much for that, Agam. Now, there's some regulatory news to tell you about. The RBI has introduced a liquidity management framework for NBFCs. Not all NBFCs. There are a certain number of NBFCs, large NBFCs essentially, that will fall under this new framework, which will essentially require them to have a liquidity coverage ratio. The ratio will be stepped up in a phased manner starting December of 2020, going up to December of 2024. But Vishwanath Nair has all the details in this report.
The Reserve Bank of India on Monday released its final guidelines on the liquidity management framework for the non-banking finance system. Remember that back in May, the Reserve Bank had released a set of draft guidelines. So the final guidelines are pretty much similar to what the draft guidelines such as just suggested, except certain minor changes in the way it can be implemented in the NBFCs. First and foremost, the most important part of this entire liquidity management framework is the introduction of an LCR, or a liquidity coverage ratio regime for the NBFC segment. Here, the Reserve Bank of India has said that NBFCs will have to maintain, at least the larger ones, will have to maintain a 100% LCR ratio. However, the implementation of this will be in a phased manner so that it's easier for the NBFCs to adhere to the norms. Currently, banks already are following a 100% liquidity coverage ratio regime. For NBFCs, the process of maintaining 50% of LCR will start in December 2020, and by December 2024, the number will have increased to 100%. So what exactly is consisting of this LCR? Well, these are high quality liquid assets which the NBFCs will have to maintain. The RBI has given specific directions to the NBFC as to what qualifies as a high quality liquid assets. This includes, of course, cash and government securities and any marketable securities which are not issued by banks, NBFCs, or any of its affiliates. Remember that as part of this entire framework, the NBFCs can use the liquid assets when they are in severe financial stress. What the RBI qualifies as a severe financial stress is a set of parameters. Essentially, if the NBFC is facing a runoff of a high proportion of its deposits, or there is some kind of partial loss on the unsecured credit that it raises from the market, or any partial loss in the secured debt that it raises from the market for short-term financing, as well as any kind of contractual flows that may happen from the NBFC's cash position because of a rating downgrade. All of this qualifies as a severe financial stress situation, and in these situations, the NBFC can use these high-quality liquid assets and maintain its liquidity position. However, it will have to write to the RBI and clarify why it is doing this and how it intends to correct the situation. Apart from the liquidity coverage ratio regime, the NBFCs are also required, or the boards are also required, to come up with a airtight framework which will ensure that the liquidity position of the NBFCs is monitored regularly, and there are specific steps with respect to how the governance of this liquidity management framework is taken care of. With respect to the mismatches in the asset liability position of the NBFC, the RBI allows certain deviation in the short-term side of the liquidity position. So essentially, if the liquidity is between 1 and 30 days, so there, depending on the bucket that you're in, it allows about 10 to 20% of negative deviation. This is essentially to make it easier for the NBFCs to adhere to these norms. Apart from this, of course, the NBFCs will also have to disclose certain key parameters such as funding concentration, or the top 20 large depositors, the top 10 large borrowers, as well as funding concentration based on significant instruments or products, as well as the NBFC's exposure to CPs, NCDs, and other short-term liabilities. So all of these will have to come out in the form of disclosures by the NBFCs. Now, a liquidity management framework was necessary for the NBFC segment, primarily because of what happened last year with the Island FS group. After that group had collapsed, there was a virtual freeze in the market, and NBFCs were not able to raise funds. So in situations like that, how will NBFCs manage their liquidity position and stay afloat? Well, this is the RBI's answer as to how they're supposed to do that and how they can continue doing their business even in stress situations.
All right, Burger King India is looking to hit the markets here to raise funds for an expansion. The Indian franchisee holder of the global burger chain has filed its draft red herring prospectus with the SEBI to raise as much as 400 crore rupees. Charlene D'Souza has the details.
Burger King India has filed for its initial public offering as it looks to raise capital to expand in the country. The burger chain plans to raise up to 400 crores by issuing fresh shares, while QSR Asia, the majority stakeholder in the company, is also looking to offload 6 crore shares, according to the DRHP filed by the company. The company is yet to disclose the pricing details of this issue. QSR Asia is indirectly backed by Everstone Capital and Ajay Kaul, the former CEO of Domino's Pizza chain operator Jubilant Foodworks Limited. Kotak Investment Banking, CLSA India Private Limited, Edelweiss Financial Services Limited and GM Financial Limited are the bankers to the IPO. Burger King will use rupees 290 crores of the IPO proceeds to open new stores. The chain plans to expand from 202 outlets as of June to 325 outlets by the end of 2020. As of June 30th, of this financial year, it reported revenues of 212 crores and its net loss stood at 1.76 crores in the quarter. India's 4 lakh crore food services market is expected to grow at an annualized rate of 10.5% over the next 5 years to touch rupees 6.75 lakhs crore, the company said in its DRHP. Over the next year, it is expected to grow at 22%.
All right, let us know what you think in terms of what you prefer when you're going out to get your junk food. Meanwhile, let's talk about the situation in Delhi. The Supreme Court ordered a ban on construction activity in Delhi and also has called for strict action from the state governments of Delhi, Haryana and Punjab to curb stubble burning in the state, in those states, as air quality in Delhi remains hazardous. Arpan Chaturvedi reports.
The top court has expressed anguish at the manner in which the 3 state governments of Delhi, Punjab, Haryana and also UP have handled this issue of stubble burning, which has led to worsening air quality in Delhi. The top court bench of Justice Arun Mishra today ordered a number of directions which include a complete ban on construction and demolition activity within Delhi NCR. The top court has also said that if instances of garbage burning, as well as if someone is found to be undertaking construction and demolition activity, there will be penalty of 1 lakh rupee if anyone is found to be undertaking construction and demolition activity. The top court also has summoned the chief secretaries of Delhi, Punjab and Haryana and has asked them to explain as to why the respective state governments should not be made liable for failing to adequately address this problem. The top court has also asked the entire administration of these 3 states to ensure that no further instances of stubble burning takes place, and has also made it clear that if this direction is found to be violated, the entire state administration, starting from the top, which is the chief secretary of the state, to the Gram Pradhans, will be made liable. Apart from that, the top court now has also today said that with the worsening of air quality, they have also empowered the EPCA, which is the Supreme Court mandated body, to check the pollution levels in Delhi, to take a call on whether they should allow diesel vehicles to ply within the city for the next few days. After this, of course, the case was adjourned, and now the top court will take it up on October 13th to review the progress made by these directions which have been passed today.
All right, now it is likely to be a subdued quarter for Tech Mahindra on a consolidated basis. The quarter will see the impact of the AT&T deal that was signed in September this year. Agam Vakil is here to take you through the key expectations from the IT major. Agam, how's it looking?
Alex, you mentioned about the AT&T deal, and I'll be coming to that. Of course, in the long term, it's a positive, but there are near-term challenges that the company has to go through. To start off with, your expectations, we're expecting about a 3% up move as far as revenues are concerned. That is relatively strong, but the challenges will come in terms of margins, where we are looking at margins, perhaps looking at an expansion to around 12.2% against 11.5%. Profit, on the other hand, is expected to decline around 2% at around 940 crores. Now, the revenue growth will, of course, largely be led by communications, considering they have signed that big deal with AT&T. However, there will be certain transition costs which will also come into play. play, which may impact profitability. This transition cost actually involves investments and the early on investments which actually go into this deal. That said, there may be slackness when it comes to the enterprise vertical as well, which continues to remain under pressure, and not much has changed in the last couple of quarters, which is why, in terms of what factors we are keeping an eye on, is of course margin implications for AT&T deal. We're keeping an eye on operating margins and the outlook there given the currency. Also keeping an eye on what the company is doing to ensure recovery in the enterprise segment. Large deal pipeline and M&A strategy along with capital allocation as to how they're using their free cash flows is something that we're also going to keep an eye on. But on the whole, it's going to be, well, I would say a quiet quarter for Tech Mahindra.
Agam, shifting gears and talking about Titan Company as well, earnings, of course, today. What are we expecting with regard to the headline numbers? And additionally, of course, the outlook is going to be keenly watched.
Right, Alex. So, coming down to Titan, the company's already indicated that it's going to be a very soft quarter in its quarterly update. Well, based on that, in terms of expectations, we're likely to see an uptick of only nearly 4% as far as revenues are concerned. Margins will see an expansion of around 11.2%, but that is largely on account of the gross margin expansion. And net profits are likely to see an up move around 15%. Of course, net profit is going to see the benefit of tax cuts that will be incorporated from this quarter. But in terms of jewelry segment, that is the segment from which the company gets over 80% of its revenues, is going to be under pressure, as indicated by the company, and where they suggested that the month of July was very slow, and in fact they saw a decline. If you actually consider the retail sales, that grew by 7%, but there were a lot of hedges which matured because of the fact that they saw a rise in gold prices, and hence this segment is likely to will show a degrowth of around 2% on a year-on-year basis. And well, moving on, as far as watches is concerned, again, we're likely to see some amount of moderation, which has been very strong, but for now we are expecting about a 7% growth there in revenues. And of course, eyewear, which is a very small part of their business, no more than 3% to consolidated revenues, has seen a robust 28% growth. But well, all eyes will remain on the jewelry segment. And well, interestingly, I'm also curious about how their sari business is doing, because we certainly have started seeing an uptick there.
Thanks so much for that, Agam. All right, two other stocks that you have to watch out for in trade today. Somit Sarkar is joining me now to tell you all about the stocks in news. Good morning, Somit. What's in the list?
Good morning, Alice. I'll start off with the earnings. Bharat Electronics, the results were below estimates. Weaker execution and lack of EVM orders dented the top line of the company, while higher tax rate impacted the net profits. Persistent System results were largely in line and better than what the analysts were expecting. Revenue beat was largely on the back of growth in the IP revenues, and better than expected this growth in IP revenues and margins led to better profit beat. SRF results were largely in line with analyst estimates. Chemical business continued to grow while the other businesses remain weak. Chemical business growth primarily was driven by the growth in the specialty chemicals business, while the refrigerant business was impacted due to auto sector slowdown and drop in global prices. Sun Pharma subsidiary Traro also reported its Q2 FY20 numbers. Numbers were muted. Net sales increase driven by increase in overall sales volume, while the operated profit, that is the EBITDA, was dented by higher R&D and selling costs. On the other results, Mahindra Holidays, Sudarshan Chemicals and TCI Express reported strong numbers, while Godrej Agrovet, Intellect Design and Care Ratings reported a weak set of numbers. On other stocks in news, Bajaj Finance, where the company has launched its QIP with a floor price set at close to 4,020 rupees. Now the floor price, it has a discount of nearly 2% to the closing price, while the board will meet on November 7th to approve the final issue price and to allot shares to the QIP buyers. Tata Steel, their arm has sold their entire stake, that is 56.5% stake in Vietnam-based Nat Steel Vina for around 36 crore rupees. And in key bulk deals, couple of stocks. Firstly, Yes Bank, where Rakesh Jhunjhunwala has acquired 0.5% stake, and secondly in Welspun Corp, where Abu Dhabi Investment Authority has acquired nearly 1.4% stake.
Thanks so much for that, Somit. All right, let me take you through some of the stories that you'll find on the website BloombergQuint.com if you were to go up and look right now. The Reserve Bank of India has tightened rules for compensation packages offered to top managements at private lenders and introduced mandatory rules to claw back rewards should a lender falter. The RBI's final rules, which followed a draft set of guidelines put out for consultations in February, come against the backdrop of a weak asset quality performance for a number of private sector lenders over the past few years. Now, the managing director and chief executive officers of credit rating agencies shall not be the members of their rating committee, according to the Securities and Exchange Board of India. Instead, these committees of rating agencies shall report to a chief rating officer. Now, a few of you watching have questions about how to access Ask BQ. It's the same way that you're accessing All You Need to Know. It starts at 12:30, and you can bring all your questions on equity, and we'll try to have all of them answered. Thanks so much for watching. This is Bloomberg Quint.